If I tell you a video game costs like exactly $100, and you look in your wallet and you hand me a crisp $100 bill, we're even.
Right.
Like, it's a clean one-to-one exchange. It's comforting almost. But what if I told you that you were fundamentally wrong?
Oh, totally wrong.
Yeah, because if you are an employee, that $100 game actually just costs you $143 of your life.
Which is just, I mean, it is the absolute definition of a mathematical mirage.
Yeah,
We walk through life looking at price tags, assuming the number we see is, the value we give.
exactly.
But beneath that visible transaction is this hidden current that just drags away our time and our labor before we even reach the cash register.
Well, welcome to another deep dive.
Hmm.
And today our mission is to really decode the hidden mechanics of money. We're going way beyond surface level budgeting advice.
Right? No skipping lattes today.
No, definitely not. We're exploring a fascinating explainer text designed for 10th graders.
Yeah, 10th or 11th graders?
Right. And it breaks down the underlying math of why everyday purchases feel so incredibly expensive to most of us. And more importantly, we are going to look at how a completely different group of people, the self-employed, navigate the exact same economy.
Looking at the exact same price tag.
Exactly. But interacting with them in a fundamentally different way.
We usually think of tax law as this impenetrable labyrinth of CPA jargon and endless forms.
Oh, absolutely. It's terrifying.
It is. But if you strip away all that noise and just look at the raw sequence of how a single dollar moves through the economy, you uncover a massive blind spot.
Yeah.
So we are grounding today's discussion in these foundational financial models that they reveal how different structural flows dictate our purchasing power.
It is a profound realization when you see the numbers actually laid out. I mean, it completely flips how you think about earning and spending.
It really does.
So the fundamental question we are setting up for you today is this. Are you paying for your life once, or are you accidentally paying for it twice?
Yeah, and to understand how to optimize our money and to really grasp the mechanics we've uncovered in our research, we first have to understand the default system.
The one almost everyone operates within.
Exactly. The system the text refers to as the W-2 trap.
The W-2 trap, I mean, it sounds a little ominous.
A little bit, yeah.
But it is just the daily reality for
Yeah.
anyone who receives a standard paycheck. Let's look at the financial flow for a typical employee. It is a rigid, mandatory three-step sequence.
Burn, tax, spend.
Burn, then tax, then spend.
Right. When you have a regular job, you earn what is called your gross income. That is the big, exciting number on your offer letter.
When you brag to your parents about.
Exactly. But the government takes taxes out of that gross income first. They get the very first bite of the apple before a single cent ever reaches your personal checking account.
And what you were left with is your net income, which, consists of post-tax dollars. This is the money you actually have available to pay for your lifestyle.
Yeah.
Your rent, your groceries, your travel. It's basically what you use to survive.
And the crucial distinction here, and honestly, the reason it is a trap, is that you are buying things with money that has already had a significant chunk permanently removed.
Yeah.
And that creates a mathematical friction. Most people feel this friction implicitly when they look at their bank balance at the end of the month.
Oh, for sure.
But very few people actually sit down and calculate the sheer weight of it.
Okay, let's unpack this. Because we need to run a thought experiment using the math we found in our research.
It makes the friction impossible to ignore.
It really does. Let's go back to that video game. Imagine you want to buy a game, and the sticker price is exactly $100.
A nice round number.
Right.
If there were no taxes in the world, you would go to work, you would create $100 of value, your employer would pay you $100, and you would buy the game.
A perfect one-to-one ratio.
Exactly.
But let's assume your overall tax rate is 30%. State, federal, everything combined. When I first looked at this, my immediate instinct was to do simple additive math.
Like most people.
Yeah. I thought, okay, if I want a $100 game and I lose 30% to taxes, I just add $30. I need to earn $130.
Makes intuitive sense.
But hold on, the math here completely broke my brain for a second. Why is that intuitive math mathematically wrong?
Because taxes are subtractive from the top, not additive from the bottom.
Okay.
If you earn $130, the government takes 30% of that whole amount. So 30% of 130
Like
is,
$39.
right, $39.
Yeah.
Subtract 39 from 130, and you are left with only $91.
Well,
You are still $9 short of buying the game.
wow. Okay. So to actually get $100 into my pocket after the government takes its 30% cut, I have to earn significantly more.
Yes.
I have to earn like roughly $143.
Exactly. Because if you earn $143 and the government takes 30% of that gross amount, well, 30% of 143 is roughly $43.
Oh.
So 143 minus 43 leaves you with your clean $100 bill.
This is wild. When you or I look at a $100 sticker price, our brains just blindly accept that as the cost. We think the item costs $100.
Right.
But to actually acquire it, our labor has to cover a hidden 43% markup just to get back to zero, just to have the privilege of standing at the cash register.
It is the brutal reality of post-tax dollars.
Yeah.
You are not just paying the retailer for the product, you are forced to pay the government for the right to earn the money to buy the product.
I want to frame this differently, to really ground it in reality. It's almost like a temporal markup.
Ooh, I like that.
You aren't just paying cash, you are paying in Tuesday afternoons.
Oh, wow.
Like, if your hourly wage dictates that you earn $100 by Monday evening, you can't just go buy the game. You have to sit at your desk until, like, 3 p.m. on Tuesday just to generate the extra $43 to satisfy the government.
Just for the privilege of keeping the money you earned on Monday.
Exactly.
That is a phenomenal way to visualize it. You are trading your unrecoverable human lifespan. And this abstract math of a video game, it translates into a much heavier, much more painful toll when we apply it to major life experiences.
Which brings us to the psychological core of what we uncovered in the text.
Yeah.
You know, the concept of your time, your labor, and the double penalty.
Yes. So let's shift from a small purchase, like a video game, to a larger lifestyle expense.
Like a vacation.
Exactly, a vacation. Let's walk through another scenario using a slightly different tax rate to keep the numbers clean. Imagine you want to go on a weekend getaway that costs $100.
Okay.
You work at your job, and you generate $100 of gross income.
But in this scenario, let's say the government takes 20% of your paycheck in taxes.
Yeah.
So from the $100 you earned, you only get to keep $80.
Right. You earned $100, you paid $20 in taxes, you have $80 left.
Yeah.
But the vacation costs $100. You literally cannot afford the vacation you just worked to pay for.
So what do you have to do? You have to keep working. You must generate more gross income just to cover that $20 gap.
And what's fascinating here is how this sequence fundamentally changes the nature of purchasing. The financial data defines this specific sequence as paying twice.
Paying twice is a profound and kind of depressing concept when you let it sink in.
It really is.
Because first, you pay the government a portion of your wealth, your taxes, simply because you worked. Then you use your leftover, your diminished money to pay for the vacation.
Right.
You worked extra hours to cover the tax gap and then spent the rest on the trip. You pay once in the extra labor required to bridge the shortfall, and you pay a second time when you hand over your post-tax cash for the hotel.
It is a dual expenditure. You are spending your time to satisfy the tax burden, and then you are spending your actual currency to satisfy the vendor.
Wow.
Part of the lifespan you dedicated to working goes directly to taxes, and only the remainder goes toward the experience you actually wanted.
I want to stop right here and put this directly to you, the listener. Think about your last real vacation. Think about the flights, the hotel, the dinners out. Look at the total cost.
Yeah, picture that number.
How many extra, completely uncompensated days did you effectively have to sit at your desk, answering emails, sitting in traffic, enduring meetings, just to pay the tax on the money you used to book those flights?
When you calculate it through that lens, a 2-week vacation might actually represent 3 weeks of your labor.
That is just, ugh.
The true cost of your life is magnified because taxes hollow out your earnings before you ever get the chance to deploy them.
It is an incredibly sobering thought. We are just bleeding time.
Yeah, we are.
But if the W-2 flow is this unavoidable trap of double paying, if it is just a fundamental mathematical reality of being an employee, the logical next step is to examine if there is an alternative route.
Right. Is there a way out?
Is there a way off this treadmill? And our research points to a very specific structural alternative.
This is where we shift away from the W-2 trap and look at the financial model for business owners, freelancers, and independent contractors.
The side hustle.
The model we often think of as a side hustle, yeah.
And here's where it gets really interesting. The financial flow for a business owner completely shifts this sequence. It changes the order of operation.
Completely.
Remember, the employee flow was earn, tax, spend. The business owner flow is earn, spend, tax.
And that simple repositioning of the word tax from the middle of the equation to the absolute end of the equation, it changes everything about the math we just discussed.
Yeah.
It alters the physics of how your money works.
But obviously, you can't just spend money on anything to avoid taxes, right?
Yeah.
Like, I can't just buy a jet ski and say it's before taxes.
Unfortunately, no. The IRS has rules.
Right. There is a very specific magic phrase that governs this. Ordinary and necessary.
Yes, ordinary and necessary.
You earn money. But before paying taxes, you are allowed to spend money on things that are ordinary and necessary for your business to function.
But this raises an important question, though, about the line between life and business. Like, what differentiates a personal lifestyle expense from an ordinary and necessary business expense?
It can get blurry.
It can. We can use travel as our primary example because travel is one of those unique activities that straddles the line. It can easily be either, depending on the context.
Right. Like if I fly to Miami just to sit on a beach and drink margaritas, that is personal.
Very personal.
I have to pay for that with post-tax dollars. The W-2 trap applies. But if I fly to Miami to meet a potential client or attend a conference in my industry or source materials for my freelance design business.
Suddenly, that exact same flight on the exact same plane, sitting in the exact same seat, becomes a business expense.
And because it is classified as a business expense, it comes out of the earn pile before the tax pile is ever calculated.
Exactly. You are utilizing pre-tax dollars.
I want to push back on this for a second because I want to make sure I am understanding the sheer gravity of this mechanism.
Go for it.
Wait, so the text is implying that just by changing the order in which the money moves, like just by moving the spending before the taxing, the exact same dollar amount holds vastly different purchasing power.
Yes. That is exactly what the source is teaching. The tax code is not just a list of rates. It is a system of sequences.
A system of sequences.
Yeah. If you spend pre-tax dollars, you completely bypass that hidden temporal markup we talked about earlier.
Oh.
You do not have to work extra Tuesday afternoons to fill a tax gap because the tax gap hasn't been created yet. You earn the money and you bought the flight.
You just eliminated the paying twice penalty entirely. We are back to that clean one-to-one equation from the very start of our deep dive.
Exactly. A $100 flight costs exactly $100 of labor.
That is incredible.
Precisely. But we need to explore why the government allows this, because it isn't just a loophole. It is a fundamental pillar of economics.
Okay.
The mechanism here is that the government taxes profits, not revenue.
Okay, explain the difference there, because I think that's where a lot of people get lost.
Sure. Revenue is all the money a business brings in. Profit is what is left over after they pay their expenses.
Got it.
Why does the IRS do it this way? Think about a standard grocery store. Grocery stores operate on razor-thin margins, often around like 1 or 2%.
Really tight margins.
Very. They bring in millions of dollars in revenue, but they spend almost all of it buying the inventory, paying the cashiers, and keeping the lights on.
Right.
If the government taxed a grocery store on its raw revenue before expenses, like they do to a W-2 employee, every grocery store in the country would go bankrupt overnight.
Ah, that makes perfect sense. They would owe more in taxes than they actually keep in the bank.
Exactly. The tax code inherently recognizes that it costs money to make money. A business must be allowed to survive its own operational costs before the government takes a cut.
Which is why the earn-spend tax sequence exists.
Yep.
But the financial benefits do not stop at just avoiding the double penalty. Because by changing the order of operations and spending those pre-tax dollars, the mathematical end result completely alters the business owner's final tax burden.
It shrinks it.
Which brings us to the concept of lowering taxable income.
And if we connect this to the bigger picture, it leads to a striking reality. The text explicitly claims the government effectively helps pay for your business expenses by letting you deduct them from your income before taxes are calculated.
So wait, let's run the numbers on that to make it concrete.
Okay.
If my side hustle earns $10,000 and I have $2,000 of ordinary and necessary travel expenses, like that flight to Miami to meet a client, I don't pay taxes on $10,000.
Yep.
The government only looks at the $8,000 that are left over.
Correct. Your taxable income has shrunk. You have reduced the size of the pie that the government is allowed to take a slice from.
But wait, let me stop you right there.
Sure.
I hear this all the time from financial gurus online, and it always sounds like a write-off fallacy.
The famous write-off fallacy.
Yeah. Saving money on taxes is great, but I still had to spend $2,000 on the flight and hotel to get that tax break.
Yeah.
I am still out $2,000 of cash.
Right.
I shouldn't just go buying flights I don't need or laptops I won't use just for the tax break rate, because I'm still losing money overall.
That is a brilliant point, and it is the biggest trap new business owners fall into.
Yeah.
You are absolutely right. A tax deduction is not free money.
Okay, good.
If you are in a 30% tax bracket, spending $1,000 on a business expense saves you $300 in taxes.
Right.
But your bank account is still down $700. If you bought something useless just for the deduction, you just wasted $700.
It's like using a 30% off coupon for a luxury item you couldn't afford and didn't even want in the first place. You didn't save $300, you wasted $700.
Exactly. The true power of this system only unlocks in two scenarios. First, if the expense directly grows your business like buying advertising that brings in new clients,
Yeah, an investment.
it is an investment that yields a return. Second, and this is where the lifestyle design comes in, it unlocks massive power for dual-purpose expenses.
Okay, what do you mean by dual purpose?
Things you are highly likely to buy anyway, but that can legitimately be structured as a business expense.
Like a laptop.
Perfect example.
If I needed a computer and I buy it as a W-2 employee, I'm using post-tax dollars. I'm paying full retail plus that massive labor penalty.
Yeah.
But if I run a freelance graphic design business and I buy that exact same laptop to do client work, it becomes a pre-tax business expense.
Right. And because you reduced your taxable income by the cost of the laptop, the government effectively subsidized your purchase by the amount of your tax bracket.
So if the laptop was $1,000 and I avoided $300 in taxes, the net cost to me was only $700.
Exactly.
It really is like unlocking a permanent lifestyle discount code.
Yeah.
But like only if you actually need the item to generate income.
Right. It has to be ordinary and necessary.
Right. The W-2 employee pays full retail price plus a massive labor penalty just to earn the money to pay full retail. Meanwhile, the business owner gets the government to effectively cover 20 or 30% of the tab purely because they operate in the earn, spend, tax sequence.
It is entirely about structure. You are sheltering your capital from the friction of taxation until the very last possible moment.
Okay, let's pull all of this together. We've gone really deep into the mechanics of money today. But the core lesson for you, the listener, is really a profound shift in perspective.
It really is.
As an employee trapped in the W-2 flow, your financial sequence guarantees you will pay taxes first and spend second.
Yeah.
You are caught in a system where you will mathematically always pay for your lifestyle twice.
Paying twice.
Once with your labor, your time, your Tuesday afternoons, and once with your diminished post-tax cash.
But as a business owner, even just operating a small side hustle, you flip the script, you spend first on your business, and you pay taxes only on the leftovers.
You protect your time, you maximize your purchasing power, and you force the tax code to work as a strategic subsidy rather than a punitive drag on your wealth.
So true.
So what does this all mean? We've looked at the raw math. We've seen how the difference between gross and net income creates a divergence in how money works depending on your professional status.
Right.
But where does this leave us in the grand scheme of things? Because this feels bigger than just keeping receipts for a laptop.
It is. I think it leaves us with a rather philosophical realization about the architecture of the system we live in.
Okay, how so?
Well, we spent this entire deep dive looking at the clinical math of lowering taxable income, which was exactly what the text explained. But if we step back and look at the whole board, look at the incentives that weren't explicitly discussed in the source, the entire tax code mathematically punishes the W-2 flow. It demands extra labor, it forces double payments, it creates massive friction.
Oh, absolutely.
Simultaneously, it financially subsidizes the business owner's flow, actively discounting their expenses and protecting their capital.
That's heavily tilted.
Exactly. This isn't an accident. It suggests our economy is secretly fundamentally designed by the government to systematically incentivize entrepreneurship, investment, and risk-taking over traditional, stable employment.
Wow. It begs the question, are we all just playing a massive game where the rules heavily structurally favor those who are willing to step outside the safety of a paycheck and build something of their own?
It certainly looks that way.
Is the W-2 trap simply the hidden entry fee for playing it safe, while the real mathematical rewards are strictly reserved for the risk takers.
It is a question every person has to answer for themselves once they see the math. Once you realize the game is asymmetrical, you have to decide which side of the equation you want to live on.
That is a fascinating thought to chew on. It definitely changes how you view a standard 9 to 5, and it changes how you look at every single price tag on a shelf.
It really does.
Thank you for joining us on this deep dive. The next time you look at your paycheck, the next time you book a flight, or even just buy a video game, we hope you look at that transaction through this entirely new lens.
Absolutely.
Remember, that clean, one-to-one exchange of value, that $100 price tag for a $100 bill, it might just be a mirage unless you know exactly which sequence you are using to process the transaction. Until next time, keep diving deep.